All right, hi, and welcome to September's edition of CORA College. My name is Justin Hewins, and I'm a partner at CORA Capital Advisors. Our topic today is about tax-advantaged charitable giving. Joining us is James Putman from Eaton Vance. James has been with Eaton Vance for over 20 years and is currently a regional director with the firm. We've been working with James and Eaton Vance since 2015, and he will be discussing the Eaton Vance U.S. Charitable Gift Trust. This trust provides a solution for charitably inclined clients to receive significant tax benefits while providing income to beneficiaries over their lifetime. Welcome, James.
Welcome, Justin. Thanks so much for having me today and those folks on the other side. I did have a few technical difficulties, but looks like you can see me loud and clear. My goal today is educate. I think if I can teach something to someone, one little thing that helps them with their lives, in this case, their income and their charitable giving, we've done a good job. Going to take questions kind of as we go if you need to. If you need to follow up with Justin going forward, we're happy to do that as well. So by way of example and by way of background, I've enjoyed charitable giving my whole life. I got that from my dad. I've had my own donor advised fund for many, many years. And when we introduced this newer solution for charitable giving a couple years ago, I decided, you know what, it made a lot of sense as well. So just by comparison, really from the very beginning, if you have a foundation or a donor advised fund, it allows you to give money away to charities while you're alive. You receive a tax benefit upon funding that foundation or donor advised fund. You do not receive an income benefit. And then when you pass away, the proceeds that are still left in that account can be distributed to the charities of your choice. It gives you total control on who you want to give money to during your lifetime. Legacy Income Trust is kind of on the other side of that, in that it does some of the same things, just in a different way. So U.S. Legacy Income Trust, this version was founded in 2019, but it does have about a 20-year predated history as a different solution vehicle. So I do have this myself, so at some point I'm going to kind of walk you through my own personal experience, because I think that makes it easier for you to understand a real-life example instead of just talking points. There is a great website, uscharitablegifttrust.org, which I think Justin's going to have kind of the main page up there for the purposes of viewership. But let's talk about what it is. I kind of like to talk about U.S. Legacy Income Trust as a Swiss Army knife. Why Swiss Army knife? Because if you had a Swiss Army knife growing up as a kid, it could do a multitude of different things depending on the situation that you were in at the time. As a Boy Scout, it was a great thing to have in your pocket when you went camping to get you out of some trouble. So U.S. Legacy Gift Trust works like this. You can contribute either cash or securities, and that securities are defined by stocks, bonds, mutual funds, and ETFs. You can contribute those into the trust to open your account. The minimum investment to start the trust is $20,000. If you were to try and open a good old charitable remainder trust with your estate lawyer and your accountant, the minimums would be a lot higher. There would be a lot of costs associated with that. There is no cost associated with setting up the trust. I always tell people the cost of the trust is the amount of time you put into filling out the application and getting things rolling. So you fund the trust with appreciated assets or cash, and you get an upfront deduction. Now, the deductibility of your contribution is based on IRS regulations. We did not do this on our own or in a vacuum. We have to follow IRS regulations. The regulations are pretty minimal or pretty simple, easy to understand as far as how much you can contribute in a given calendar year before you can add that deduction to a following year and the year after that. So you contribute to the assets to the trust. Based on the age of the people on the trust, you get an upfront tax deduction. In a donor advised fund, you would get a full deduction for the amount invested. In a legacy income trust, it's a partial deduction based on the ages of the people in the trust. Now, the difference between a legacy income trust and a donor advised is that a legacy income trust will now generate income off of that account. That income can be distributed to 1 or up to 10 individuals over the lifetime of those individuals. At the end of the last income beneficiary's life, the value of the trust is liquidated and distributed to the charities that you picked along the way at the beginning of the form, or if you want to change them down the road. So contribute some appreciated assets or cash, get an upfront deduction based on age, get an income stream on a monthly basis for life, and at the passing of the last income beneficiary, the charity of your choices would receive the benefits of the account value. So that's kind of the gist of it. Justin, if we could put up the page for Legacy Income Trust number 1, just show you quickly what that kind of looks like. It's 1.2. There's a new version every couple of years for Legacy Income Trust. So 1.2, you'll see, put it on my own little screen over here, that it has a value, a current value per share of $8.40. And you'll see in the middle that the annualized distribution per unit is 52.5 cents. So here's where I'd like to go to my own personal example, because this is what I have. So in December of 2020, I contributed Eaton Vance stock that I'd had in my account. I'd had some appreciation to the stock, and the stock distributed me about a 2.5% dividend on a quarterly basis. So real numbers, I contributed $22,000 of Eaton Vance stock, put it into the trust, filled out my form. They sold my Eaton Vance stock, and they reinvested those proceeds into an account that all the other people that have shares of the trust share in. The account is an equity account of both US and non-US equities. I now receive a 52.5-cent dividend per share off of the account. So at the current rate of $8.40, if you were to open the account today, which would be kind of hard to do, you would have X number of shares times 52.5 cents. That 52.5 cents is paid on a monthly basis. So my $22,000 initial investment generates for me about $173 on a monthly basis. You'll see on the screen that again at 8.40, the 52.5 cents a share is the per unit distribution at the current NAV, net asset value of the trust. That's about a 6.25 yield or distribution rate on the assets. Now, this is not a fixed or guaranteed number. It will fluctuate depending on the share price of the portfolio the day you open the account, if you choose to do so. So if that price of 8.40 goes higher, your initial investment would have less shares to buy. If it goes down, you'd have more shares to buy, just like a mutual fund would be, or an ETF or similar vehicle. So I put in my Eaton Vance stock. I got an upfront deduction. I only put myself on the account. And I'm going to come back to if I had added my family on there as well. So I got an upfront deduction of about 64% of the value of the portfolio. Justin, if you would go to the calculator page, that would be great. And I will pull up on my end. That'd be the third one down. Yep, the calculator page. So we'll keep this live. Just one life. You'll see calculate charitable income tax deduction. If I put in my current age, which will be 62 in a couple of days, we'll fast forward to my birthday and hit calculate. This is, again, an IRS calculation, not something that Eaton Vance created in a vacuum home office. So if I were to open an account today as a 62-year-old, my upfront deduction is 64.066% of whatever the amount of money I contribute to the trust. That number goes higher as age goes higher. So the older you are, the bigger your upfront deduction. Now, let's step back a little bit and go back to my example. I just had myself on the account. Had I added my wife and children onto the account, the deductibility number goes down. That's because my children were 24 and 6 at the time. My wife is the same age as I was. My upfront deduction would go down because the income will be paid out much longer because my children were younger. So again, Swiss Army knife. I needed this to give me the biggest deduction I could. Had I not worried about the size of the deductibility, I would have added other income beneficiaries. So it's up to you. It's up to your decision. It's your Swiss Army knife. What do you need it to do for your situation? So I get myself, again, the $173 check, the 5th of every month. At the time of my passing, the trust will be liquidated, whatever the value happens to be. It'll be distributed to the charity I listed on my opening form. So there's a few things. There's one thing you can adjust to this and others that you cannot. Once you've opened a trust account, you cannot add or subtract income beneficiaries, but you can change the charity that will get the money at the end of the last income beneficiary's lifetime. So that is something you could change over time if you feel that's the need. But once you set up the trust with 1 or 2 or 3 or 10 people, it's kind of set for life and goes from there. So again, contribute appreciated assets, receive an upfront deduction based on age, receive a kind of dividend, if you will, over your lifetime or the other lifetimes that are involved. And at the end of the last lifetime, the money goes to charity. Now, from a tax standpoint, obviously you're helping reduce your adjusted gross income with a charitable deduction like any other charitable deduction. The income that comes off of this is taxed at the qualified dividend tax rate, or otherwise known as long-term capital gain tax rate, which, as most of you know, that number's here, your income tax rate is always going to be higher than that for the most part. So it's a nice feature. We call it tax advantaged income because it's not taxed at the highest rate, but at that long-term capital gain rate, which I think the max now is 23.8%, whereas the max income tax bracket is, 37 plus state, and all the other ones, north of 50%, especially here in New Jersey. So again, multiple people. Now, let's go back to, I did add my wife, I did add my children. So now there's an income stream for 4 people. There's 2 ways, Swiss Army knife, that you can distribute that income. One way would be concurrent distribution, meaning all 4 of us, James, Susan, Grace, and Claire, all get that income the day we open the account. I can determine the percentage of the income. Being a good dad, I probably would have said 25% for me, 25% for my wife, 25% for each of my 2 daughters. I could have said, you know what? I'm in charge here. Dad's going to get 50% of the money. Mom's going to get 30% of the money. Each daughter could get 10% of the money. That's up to you to determine if you have multiple income beneficiaries and you want everyone to get income initially, what those percentages might be. So that's concurrent income distribution. The other income distribution choice is consecutive income distribution. What does that mean? That means dad, in my case, me, gets 100% of that $173 every month. At my passing, my wife would collect the money every month. At her passing, my daughters would collect the money. And once they passed, it would go to charity. So again, make it do what you want it to do over time. You're going to give to charity. It's given at the end of the last income beneficiary's lifetime. You get a pretty good income stream that's taxed at a relatively good tax rate in today's marketplace. And as you can see, a distribution rate of 6.25% is pretty good. You have 10-year treasury bonds yielding 4.3. This is even higher than that, and that's taxed at a lower rate than a treasury bond would be in your portfolio. So again, make it do what you need it to do, what you want it to do. A lot of flexibility within, but it's pretty standard to set up. It takes 4 quick steps. I think it took me, 20, 25 minutes. So again, the cost would be my 25 or 30 minutes of my time to get the form ready to go. Who do we see using this? How do we see this used out in the marketplace and in the field of people that I talk to, advisors and their clients? You're getting to the retirement age. You're looking for more retirement income out of your portfolio, but your portfolio is more kind of growth stocks and stuff that doesn't have a lot of dividends. Great. You can convert that low to non-income bearing asset into an income bearing asset. It helps eliminate capital gains, right? If you the Googles and NVIDIAs and Teslas of the world that everybody seems to own has made a lot of money in, most of those do not even have a dividend. You could contribute those appreciated assets, again, receive a tax deduction up front, eliminate that capital gain. So in a way, this is a vehicle to keep Uncle Sam away as best as we can with lowered rates on the income and no taxable event by contributing an appreciated asset. Let's say you have a concentration in a stock and you love the stock, but you have too much of it, but you don't want to sell it because you don't want to pay the capital gains tax. You could contribute some of that into the trust. Now you've again eliminated the capital gain. We've had many a client who use the income off of this to help supplement or fund a life insurance policy or a long-term care policy, right? It gives them an additional income to fund things that will be beneficial to them and their family members down the road. So again, U.S. Charitable, U.S. Legacy Income Trust, 3 different versions, minimum investment being $20,000. It does increase the distribution rate as you put in larger amounts of money. The break points, if we call them, the first trust is at a $20,000 minimum. Then there's a $250,000 minimum trust and a $1 million minimum trust account that you can open. Again, the cents per share distribution goes up. Now, I've had the trust since December of 2020. I have gotten the same check amount every month since then, and yet my money is invested in stocks. So let's think about where the market has come and gone since December 2020. By December 2020, we were starting to feel like the world wasn't going to completely end. The stock market started to recover. It had a pretty good 2021. It fell off a cliff in 2022 and has now had a good 2023 so far. So a lot of ups and downs in the stock market, both US and non-US stock markets, and yet my check remained the same every single month. There is no guarantee of that check, but the goal of the managers of the accounts is to hopefully raise those dividends over time. We had a nice little dividend raise at the beginning of 2022 from 50 to 52.5 cents in my case, and a couple of cents per share on the other trusts. So again, lifetime income at a tax advantage rate, the charity of your choices benefits when there's no more income beneficiaries out there. Again, make it work for you in the best scenario that is right for you and your family and the folks that you want to support. So Justin, I'll hold off there. I've probably talked faster and longer than I should. Covered a lot of ground. If there's any questions, either I don't know how they're going to come in, either verbally or in the queue, I'm happy to take them. So I'll pause here and turn it back to you for a sec.
Yeah, thanks a lot, James. So we'll open it up to questions. So in the, I guess, dialogue bar, there is a section for Q&A. So if there are any questions, please type them in there. I can relay them to James, and between the two of us, we can try to get you some answers.
Justin, any questions that came to your mind as we walk through this?
So I guess the one that came to my mind is, and I don't think you touched on this, but are there any types of securities that are ineligible for contribution to this trust?
Yep, good question. I did miss that. So in the literature, right now, I guess two things you cannot use as a contributed security would be municipal bonds, individual municipal bonds, and municipal bond funds. I think that's the fact that since they're tax exempt already, that would be double dipping. I know Bitcoin is out there. At the moment, I don't believe we can take it. I know in talking to the folks a few weeks ago, they are working to have, whether it be Bitcoin itself or maybe a Bitcoin ETF, be accessible. But I think Bitcoin is still not understood about how it would show up into this portfolio. How would we sell it? So I would say minimal restriction, just listed as Bitcoin and Bitcoin ETFs for now, municipal bonds and municipal bond funds. But most other ETFs, individual stocks, bonds, mutual funds, closed-end funds, if it is a listed security or security, we will accept it in the portfolio. Cash, obviously, is always accepted. That's not a big deal. It does bring up a point about deductibility that I want to make everyone understand. For a cash contribution, the maximum allowable by IRS law per year is 60%, 60% of your adjusted gross income. So let's go through a scenario. A client's adjusted gross income is $200,000, and they contribute $100,000 to Legacy Income Trust. Well, 60% of 200 is 120, so that's fine. They're under the radar. No big deal. If their income was $500,000 a year, 60% would be $300,000. You can put too much in, but you're allowed to roll that over 5 years, carry over 5 years, just like most other charitable contributions. If it's a security contribution, it is 30% of your AGI. So example number one, $200,000 adjusted gross income client contributes $100,000 of securities into the U.S. Legacy Income Trust. Well, they can take $60,000 of that 100 as a tax deductibility for this year. They would take the $40,000 that's left over and carry it over into the 2024 tax year. So you can carry over the excesses up to 5 years. Most folks aren't going to overfund this to the point where they lose a tax benefit, but you just have to be careful about what you're how much you're going to put in there. The trust, due to IRS regulations, reset every 3 years. So we're currently in trust 0.2. At the end of 2024, we will have trust 0.3. If you were to contribute to trust 0.2 this year, you would be able to make another contribution in 2024. But if in 2025 you wanted to make another contribution, you unfortunately actually have to open a new trust account of the 0.3 version down the road. Again, that's an IRS regulation that I don't really understand, but we have to follow the rules as they are. So.
All right, great. Thank you. So we have another question that came in. So someone typed in, they're expecting a non-spouse inheritance and it'll be subject to RMD. So assuming that it's, an inherited IRA, could this be a good instrument to mitigate some of these taxes since this will put me in a higher tax bracket?
So I probably should have started with this. I'm not a tax attorney, nor do I give tax advice, but generically speaking, a contribution to legacy income trust, that charitable deductibility lowers your adjusted gross income. So yes, I believe that would be helpful in this sense to be using this. Just like, if you had given the charity directly the money, it would have been the same vehicle as lowering your adjusted gross income when you go to do your taxes. When you do open a trust, you get 2 forms back once it's been opened. One shows your contributed amount and what the value was the day they sold it and what it was. So in my case, it was Eaton Vance stock, $22,030. And then you get a form that shows the IRS deductibility computation, which I just handed to my accountant in the spring of 2021 to do my taxes. So to answer your question, yes, it does. It should lower your adjusted gross income, again, with those kind of parameters of not overfunding on a given calendar year. I would consult with your tax person. But again, if you use the calculator, you'll know what that deductibility number is. And if you know how much you're going to contribute, you'll know what that deduction that will be allowable. You talk to your accountant about that, and he says, yes, that's fine, or that's too much for 1 year, but we can carry over the balance into another year.
So great. So short answer is yes. Long answer is, whether or not it's appropriate, it depends, right?
Correct.
So, I think the important thing to take away from, this presentation and this solution in general is, yes, it helps with taxes, but there's other, variables for consideration, right? Number one would be, is being charitable important to you, right? Because this primarily is a charitable vehicle. And, number two, what is your ultimate goal for the money, right? Is the ultimate goal to receive income off of? If the answer is yes, then this product makes a ton of sense. If you don't need the income, something like a charitable lead trust might make more sense, right? So that's where the income would pay to the charity. And then after a set amount of time, if there's any balance left in the fund, that balance would come back to family beneficiaries or whoever you name. So it's basically this, type of arrangement, but in opposite, right? You would receive the income in this arrangement. With the charitable lead trust, the charity would receive the income, but you'd get the ultimate benefit on the back end. So like anything else with financial planning, it depends, which is somewhat of a non-answer. But it really ties into, well, what are your goals for the money? Do you need income, or is it something that you want to give to beneficiaries down the line?
Yep, exactly.
So I guess another question that ties into what we just talked about, is it preferable to contribute cash or securities to this type of mortgage?
I think, to use the word preferable, it's securities that have been appreciated, that have appreciated, because then you're eliminating a tax bill that you don't have to pay. And I don't think I've ever met somebody that says, no, I'd like to pay more in taxes. So an appreciated asset, be it a fund or a stock or a bond, is always preferable because you get a tax benefit, not only from the deductibility for your income tax purposes, but you eliminate paying a capital gain on that. So yeah, I would say securities preferable, understanding the lower threshold for how much you can use per year. But in most cases, you'll have those other 4 years if you have overfunded it for 1 year to be able to use those tax benefits going forward. But to eliminate capital gains to me is a much better solution than just funding with cash. I would say, in the couple of years we've had this out, I'm not sure we've ever had a cash funded one. It's mostly going to be appreciated assets, securities, because people are trying to eliminate that capital gain problem.
All right. So another question came in. So an objective of this is to mitigate capital gains, which we just talked about. Another option is investing in QOZ funds, which is qualified opportunity zone funds, 1031 exchanges, or another option, what other strategies are out there that allows you to earn short-term income and maintain the principal for children or grandchildren?
Honest answer, no idea. I don't know much about the two things you just mentioned, so I don't think I can even attempt to answer that question. I apologize.
Yeah, so I'll take a kind of a short stab at it. So QOZ funds and 1031 exchanges are real estate focused, right? So number one is qualified opportunity zones are designated by the government, right? So those are, let's say, areas of the country that they're trying to build up with business or housing or whatever it may be. So it's definitely real estate focused. And then 1031 exchanges, same thing. A little bit of a different twist on it though. So that's if you have capital gains inside of, some sort of, let's say, rental property, that allows you to defer, not eliminate those gains into another type of rental property, assuming that you hit certain criteria, which it's fairly detailed and we can get into on another call. But what other strategies are there out there that allows you to earn short-term income and maintain principal for grandchildren or children? Quite frankly, I don't think there is any that allows you to eliminate capital gains and also get income and the principal on the back end, right? You're kind of getting the best of all worlds.
Yeah.
When it comes to that. So it's sort of picking one or the other, right? Either you get the tax benefit one way or the other, and you can get income or the principal, not both. Or you pay the tax and then you get to do whatever you want to do with it. And then you get the income and principal, right? But as far as, getting some sort of tax benefits and also getting income and principal back in the end, I am unaware of a solution that would solve for all of those goals. So that's something to,
I would agree with you. Yeah, I've never heard anything, and been doing this a long time. Haven't heard any other, solutions where you, like you said, you get have your cake and eat it too, so to speak.
Yep. All right, another question. Does the income provided to beneficiaries change over time?
So the goal is to, over time, hopefully raise the dividend. So again, Trust 1 is 52.5 cents a share. It was 50 cents a share about a year and a half ago. We did raise the dividend in the beginning of 2022. But again, I've been asked the question, nobody asked the question is, could the income go away? And the kind of two scenarios where we would not be able to provide the dividend or we'd have to cut it would be that the companies we own cut their dividends and or they go out of business. So the benefit of a portfolio that you've now invested your hard-earned money into US and non-US stocks, basically all the stocks in the world, it would be a pretty draconian scenario if all of them stopped paying a dividend or all of them went to zero. So we understand inflation eats into any type of investment or any income. So the goal of the team that runs the money is to try and keep those dividends steady and raise them over time. We use, again, both US-based stocks and non-US stocks. We tend to grab a lot more dividends from non-US stocks. They just happen to be higher dividend paying companies over there. So we could just keep searching for higher dividend paying companies. But the goal is to keep that dividend steady, if not raise it. But again, guaranteed, no guarantees. There is a part of the website that it's a little wonky to find under performance, where you can look at the dividend history and see that it's been pretty steady, even though, again, going back to my own example, my portfolio value fluctuated from here to here to here to here, but I still got the same dividend check every single month. So I think that answers it.
So another question that came in, can you contribute to the trust over years?
So you can, but as I mentioned earlier, every 3 years, the IRS makes you start a new trust. Again, don't know why, just we're following the rules. So Trust 1.2 that's out today opened up in 2022. Therefore, it'll be available in 2022, 3, and 2024 to add to. If you had some more money you want to add to in 2025, you would have to open Trust 1.3 at that point in time. But yes, you can contribute multiple times in a year and basically over a 3-year period as the trusts are open. But once it closes, you cannot add to a trust that's kind of previously offered, as they talk about.
Great, thank you.
Hmm.
All right, I'll give it a couple more minutes for the last questions to flow in here if there are any. But James, was there anything else you wanted to add at the end here to wrap it up?
No, I mean, I think, you kind of said it earlier, Justin, charitable intent is really, job one in this situation for this. But this is a really great tool, Swiss Army knife, if you have charitable inclination to do things between now and the charities that benefit you and those that you love and those around you. Again, if your desire is to give money away in your lifetime and see that appreciation and the smiles on those people's faces, that's more, a foundation or a donor advised fund. This is more for, I've got a appreciated asset. I don't want to sell to generate income because I don't want to pay that tax ahead of, right up front. Keeping Sam out of it. It's something that either has little to no income that you want to turn into income. So again, the elimination of capital gains, the increase of an income stream that maybe you had that was small to make bigger, that's really what you're trying to accomplish by using legacy income trust. Charitable giving is certainly job one, but the other two pillars are eliminating taxes I don't want to have to pay if I don't have to legally, and two, getting a better income stream off of an asset that I've had for a long, long time. Like I said, mine was, I went from 2.5% to almost 6%, and I didn't have to pay Uncle Sam a penny. That was a win-win in my own situation.
Well, great, James. Thank you so much for joining us today and all the valuable information that you provided. For everyone who signed in to join us, thank you very much. Hopefully you got something out of the presentation today. If you have any follow-up questions, please feel free to reach out to us. We'll be happy to answer them on an individual basis. Obviously, everyone's situation is a little bit different. Their goals are different, which is where, a personal conversation can certainly come into play. So thank you for joining us. We do plan on hosting another CORA College coming up in October, which is intended to be on cryptocurrencies, which is certainly a divisive topic these days, but something to hopefully glean some information off of. But again, thank you, everyone, and we look forward to seeing you soon. Take care.
Thanks very much. Appreciate your time.